What if the story of New York real estate isn't an exodus, but a reset? The numbers, contracts in Manhattan, inventory in Syracuse, and towers under construction across the 5 boroughs suggest a market that's shifting shape, not shrinking. Start with a concrete street-level moment. In November 2027, New York's luxury buyers didn't slip away, they showed up. Manhattan recorded between 151 and 176 signed contracts for homes priced at $4,000 or more, up from 115 to 141 in October, a jump of roughly 25% to 31% month over month. In the last week of November alone, 17 such contracts beat the 10-year Thanksgiving week average. The market's highest end led the city, with deals over $4,000 rising at more than twice the rate of the overall market that month. Zoom out and the skyline tells its own story. In November 2002-05, Manhattan's office sector led the nation with nearly $7,200,000 in year-to-date sales, with properties trading at an average of $514 per square foot. Asking rents sat near $68 per square foot in Manhattan that month, the highest in the Northeast. The development pipeline in the borough reached close to 3 million square feet under construction, a 10% increase since the start of the year. Pair that with Boston's roughly 4,100,000 square feet, and just those two markets accounted for 22% of the approximately 32,200,000 square feet under construction nationwide at the start of December. The national backdrop matters. Across the country in November, the office vacancy rate stood at 18.5%, down 90 basis points year over year. The average listed office rent was $30.77 per square foot, essentially flat, up 0.2% from the prior year. Yet the supply pipeline shrank. About 2.2 million square feet under construction nationally represented a 44% pullback compared with a year earlier. Despite that contraction, Manhattan's pipeline expanded, bucking the national trend. The narrative that New York might empty out has been tempting in recent years. The data point in the opposite direction. The city's population peaked at 8.8 million in 2020, dipped to a trough of about 8.36 million in 22, and more recently stood around 8.5 million. Manhattan, specifically, gained 17,500 residents in 2022, most moving from other boroughs. Between 2020 and 2022-70, the 5 boroughs added about 10,000 millionaires. City planners argued in May 2022-05 that the last 2 years of growth suggest the pandemic losses were a short-lived shock. In other words, people left and people came back. The luxury market's resilience arrived amid political noise. After a June primary that remade expectations for City Hall, some predicted an elite exit. The platform at the center of that debate included increased eviction protections, rent freezes, and a 2% income tax surcharge on annual income above $1,000. Those proposals are not numbers on a deed. Signed contracts are November's $4,000 and up surge, $150.80, $70. 6 deals landed right as that debate crested, while October totaled $115 to $140. If policy becomes law, the market will adjust accordingly, but the fall figures offered a data-grounded answer to the idea that high earners would simply vanish. Wall Street helped set the tone. 2024 brought the largest bonuses since 1987. A November projection for 2025 pointed to payouts for investment bankers, traders, and wealth management professionals rising by up to 25%. Signals suggest that kind of income power can fuel demand at the top end in neighborhoods, from Tribeca to the Upper East Side, where $4,000 is a threshold, not an outlier. The office market, often cast as the drag on urban recovery, shows a more nuanced picture in New York. Manhattan and Los Angeles posted some of the lowest vacancy rates among major markets in November. Los Angeles was at 14.4% vacancy. Manhattan's exact figure wasn't disclosed alongside that number, but the city was grouped among the tightest. Meanwhile, in the West, San Francisco's vacancy hovered near 26%, and Seattle reached 26.6%, while Phoenix sat at 17.8%. Asking rents illustrated the premium. San Francisco averaged a little more than $65 per square foot, the Bay Area nearly $52.50, Los Angeles and San Diego about 46. In the Northeast, Manhattan's roughly $60 to $8 asking rate was highest, Boston's close to $49, and Philadelphia's nearly $32, making Philadelphia the only northeastern market below the national average of nearly $33 in November. And yet, the shape of work is shifting the shape of space. Co-working isn't a trendlet, it's a new layer of the office market. In 22 million square feet of co-working opened, a 16% increase from the prior year. That growth lifted the category's share by 30 basis points to surpass 2% of the market. The structured hybrid model, part in-person, part remote, has become the dominant configuration for many companies. Approximately two-thirds of firms offer location flexibility, with physical occupancy not snapping back to pre-pandemic norms, and office-using employment basically flat, flexible space has filled the gap between 5-day commutes and fully remote teams. Stand in Midtown, and you'll see construction cranes. But context matters. Nationally, at the start of December, projects in planning or under construction represented less than 2% of existing stock, down from 3% a year prior. New office starts since January totaled a touch more than 13 million square feet, enough to show activity, not enough to erase the pipeline contraction. In the South, Dallas carried more than 2,600,000 square feet under construction, Austin a little more than 1,500,000, Miami more than 1 million, and Houston roughly 1 million. Together, those four southern markets made up nearly 20% of the national pipeline. In the West, Los Angeles had nearly 2 million square feet underway, San Diego roughly 1,200,000, Phoenix 790,000, and the Bay Area almost 760,000. Against that, Manhattan's near 3 million shows New York firmly in the build conversation, even as the U.S. pipeline pared back 40 grand year over year. Sales tell the same tale of a steep premium for New York. In the West Bay Area, office space averaged $386 per square foot year-to-date through November. San Francisco clocked in at $286. In the Midwest, Chicago office assets traded at just $64 per square foot on average across $1.1 billion in year-to-date sales, a nearly 28% drop from the year before and the fifth consecutive year of price declines. Nationally, year-to-date office sales totaled more than $48 million across deals, averaging $190 per square foot. Manhattan sat atop that stack at $514 per square foot and $7,300,000 in volume. Now pivot north along I-81 because New York's market isn't just Manhattan. Syracuse has dealt with a 5-year stretch of seller dominance, unlike anything many agents have seen. In a 37-year career, one local leader called it the longest seller's market he's witnessed. But the tide is shifting. As of October 2020-2005, new listings in the Syracuse area rose for 7 straight months. Monthly increases ranged from 4.2% in October to 19% in April. Inventory expanded as well. The region had 2.7 months of supply in October, up 35% from the same month a year prior. Months of supply is a basic yardstick, how long it would take to sell all active listings at the current pace with no new homes added. More months signal more breathing room for buyers. And the pressure cooker of price over list has eased. The average percentage above list price that sellers pocketed fell for 8 straight months as of October. Prices are still higher than a year earlier in every month from November 2024 to October 2025, but the competition that once produced waived inspections and blitz bidding eased around the edges. The expectation locally, 2026 will be better for buyers than 2024 or 2025. Those micro shifts in central New York align with a broader projection for 2026, affordability gradually improving as income growth starts to outpace home price growth. A national housing index tallied a 2.9% year-over-year rise in U.S. home prices in August, with prices unchanged quarter over quarter. That gauge has recorded annual appreciation every quarter since 2012. States leading annual appreciation include New York, Connecticut, New Jersey, Mississippi, and Illinois. The Northeast features prominently, which lines up with what the biggest New York metro is already seeing. A December 2nd projection sketched a map for the next year. The hottest markets in 26 are expected to include the New York City suburbs, Long Island, the Hudson Valley, northern New Jersey, and Fairfield County, Connecticut, and the city of Syracuse. Commuters eyeing faster trains and shorter drives will be drawn to those metros ringing Manhattan. Recent graduates and early career workers, the same projection argued, will gravitate towards small and mid-sized cities where rents are attainable, places like Syracuse and Madison that offer job growth without urban sticker shock. That map comes with offsets. Several Sunbelt markets are expected to cool next year, including Nashville, San Antonio, and Austin, along with South Florida hubs like Fort Lauderdale, West Palm Beach, and Miami. One factor in those markets, the rising weight of natural disasters on homeowner insurance costs. Another factor, remote workers being called back toward office locations. If more of those workers return to New York-based employers in 2026, demand in Manhattan and its commuting belt could intensify, even if mortgage rates land only modestly lower. Mortgage pricing could downshift, but not to pandemic-era floors. The same December 2nd projection put the 30-year rate around 6.3% for 2026, down from an average of about 6.6% in 2025. It also anticipated occasional dips below 6%, but cautioned buyers not to expect sustained sub-6% borrowing. With that backdrop, existing home sales were forecast to end 2026 up roughly 3% from 2025. The spring home buying season should be stronger than in 2025, when rates ran near 6.8% during that window. Even then, some households, especially those uneasy about job security as artificial intelligence automates white-collar tasks, could delay purchasing. Renters won't get immediate relief if supply thins further. That December projection expected rents to rise about 2 to 3% by the end of 2006, roughly in line with inflation. Construction on new apartments slowed from 2021 to 2022 and isn't likely to re-accelerate soon. With fewer apartments being built, competition for each unit intensifies. Some coastal rental markets, especially in South Florida and Southern California, may see capped demand growth because of tighter immigration policies. New York's rental story, though, is shaped by its own job market and the high-income cohort that often chooses to rent in Manhattan before buying in the suburbs. Office employment adds another layer. In October, private payroll data showed office-using sectors shedding a combined 30,000 jobs. Year over year, those sectors still gained about 188,000 jobs, a 0.5% increase. Signals on artificial intelligence are also mixed but reassuring at the margin. A survey of service firms found that 13% had anticipated workforce reductions due to AI in 2027. When the same survey was repeated, roughly 1% actually reported downsizing personnel because of AI, and more firms leaned toward training their workforce rather than replacing it. For real estate, that points to slower secular shifts, not a sudden erasure of office jobs. Meanwhile, the competitive standings of office markets underline just how singular New York is. In the Northeast, Manhattan's $68 asking rent towers above Boston's roughly $49 and Philadelphia's nearly $32. In year-to-date sales through November, Manhattan's $7.30 billion eclipsed Boston's nearly $1.40 billion and New Jersey's a little more than $1.20 billion. New York assets closed at a $514 per foot average, well ahead of the national average of $190. In the West, even top performers sat a notch lower. The Bay Area led regional sale pricing at $386 per square foot year-to-date, San Francisco at $286. In the Midwest, asking rents remained most accessible. Detroit near $20 per square foot, and Minneapolis-St. $10, Paul near $27 with a vacancy around 17.8%, while Chicago logged the region's highest year-to-date sales at $1.10 billion, but at the country's lowest average sale price of $64 per square foot. These numbers don't just fill spreadsheets, they shape choices. For a midtown firm debating a footprint, Manhattan's rent premium buys access to clients, talent, and the global finance engine that just experienced its strongest bonus year since 1987. For a family in Yonkers or Huntington, a mortgage rate that drifts from 6.6% towards 6.3%, changes the monthly math by hundreds of dollars, especially if home price growth slows and inventory in the suburbs loosens. For a first-time buyer in Onondaga County, 2.7 months of supply, up 35% year-over-year as of October, means a chance to inspect, to bid once instead of 5 times, to keep contingencies that had gone missing. The city's political economy will also matter. Proposals like rent freezes, stronger eviction protections, and a 2% surcharge on incomes above $1,000 are more than slogans. They're potential changes to the cash flows and incentives that drive investor decisions. The November luxury contract totals: 151 to 176 deals above $4,000, undercut the notion of an immediate millionaire migration. At the same time, the gap between planning and policy will be a space to watch in 2026. If rental rules tighten and new construction stays constrained, upward pressure on rents could persist even as sales begin to normalize. Coworking's expansion offers a bridge while that normalization unfolds. 20% square feet opened in 25, 16% more than the year before, lifting coworking's market share by 30 basis points to beyond 2%. With about 2/3 of firms offering flexibility on where employees work, demand for short, adaptable leases remains. In Manhattan, flexible space helps companies keep a foothold while they assess return-to-office cadence. In Brooklyn and Queens, it can seed new business corridors. In the suburbs, northern New Jersey, Westchester, Nassau, Fairfield, the same flexible space keeps workers closer to home 2 or 3 days a week, feeding local retail and reducing the all-or-nothing tension of long-term leases. Against that mosaic, the phrase Great Housing Reset captures how the next chapter unfolds. The reset is not a rapid price correction, but a years-long return to balance. Gradual increases in home sales, normalization of prices, and affordability improving as incomes catch up. In New York, the reset will look different borough to borough and block to block. Manhattan's luxury segment just showed a 25% to 31% monthly surge in November's signed contracts. The office pipeline held near 3 million square feet under construction, while the national total fell to about 32,200,000. The suburbs around the city, Long Island, the Hudson Valley, northern New Jersey, Fairfield County, are projected to be among 22-6's hottest markets. And Syracuse has measurable signs of buyer relief: 7 straight months of rising new listings through October, a 4.2% increase in that month alone, and a 19% bump in April. 2.7 months of inventory, up 35% year-over-year, and 8 straight months of sellers getting less above list price. Contrast that with places set to cool: Nashville, San Antonio, and Austin in the South, and the South Florida trio of Fort Lauderdale, West Palm Beach, and Miami. Natural disasters raising insurance costs, paired with employers calling teams back to office hubs, are expected to pinch demand there. If that rotation materializes, New York's share of the national deal flow could rise, not fall. The national office economy will remain a wild card, but not an anchor dragging everything down. Year to date, the U.S. transacted more than $48 million in office sales through November at an average of $190 per square foot. High-demand coastal markets asked the highest rents. Manhattan's 60 cent $8, San Francisco's a little above $65, Boston's near $49, while Midwestern and Southern markets remained most affordable. As big tenants consolidate, one example in Minneapolis saw a large financial firm leave a nearly 1 million square foot headquarters to consolidate into a smaller building they already owned. Some local vacancy rates will rise. Others will stabilize as sublease space is absorbed and flexible options fit hybrid patterns. New projects will break ground selectively. The U.S. pipeline now represents less than 2% of stock, down from 3% a year prior. In that scarcity, Manhattan's ability to add space and fill it will be a differentiator. Base case through December 2026, a slow thaw. Mortgage rates trend toward roughly 6.3% from an average near 6.6% in 2020, with brief interludes below 6% but no sustained plunge. Existing home sales climb about 3% year over year. Rents increase around 2 to 3% as apartment construction remains muted from its slowdown between 2021 and 2022. In Greater New York, the suburbs, Long Island, the Hudson Valley, Northern New Jersey, Fairfield County stay busy as commuting patterns rebalance, and Syracuse sits among the year's standouts as inventory continues to rebuild and bidding pressure eases. Manhattan's luxury tier remains resilient, having notched between 151 and 176 contracts above $4,000 in November 2025, and the office sector retains its national lead in sales volume at $7.30 billion year-to-date, and top-tier pricing at $514 per square foot. Two things to watch closely. First, jobs. Office-using sectors slipped by 30,000 positions in October, even as they added about 188,000 year-over-year, a 0.5% gain. If white-collar hiring remains tepid, leasing timelines in Manhattan could stretch, and buyers in the suburbs may hedge. On the other hand, if the labor market strengthens and bonus pools stay elevated, 1924 delivered the largest since 1987, and payouts in 2025 were projected to rise up to 25%, luxury demand could outperform. Second, policy. Proposals for stronger eviction protections, rent freezes, and a 2% income tax surcharge on incomes above $1,000 would reshape incentives if enacted. Watch how those discussions evolve, and whether developers can pencil new projects when the national pipeline has already tightened by 40% year-over-year to around 32.2 million square feet under construction in November. New York's real estate story is not a binary of boom or bust. It's a rotation. Luxury contracts shot from 115 to 141 in October to 151 to 176 in November. Office assets traded at a premium, $514 per square foot in Manhattan when the national average was $190. Syracuse's months of supply rose to 2.7, up 35% year-over-year after 7 straight months of rising listings. The suburbs ringing the city, Long Island, the Hudson Valley, Northern New Jersey, Fairfield County, are poised for a hot year as commuting recalibrates. And the city itself continues to attract talent and capital, with population rebounding from 8.36 million in 2022 to roughly 8.5 million more recently, after peaking at 8.8 million in 2020. Watch the deals, not the discourse. If you want more data-grounded storytelling on New York's market as the reset unfolds, consider subscribing to stay in the loop.